Prospect theory is a behavioral economic theory developed by Daniel Kahneman and Amos Tversky, which explains how people make decisions involving risk and uncertainty. Here's a breakdown of its key concepts. Value function. Prospect theory suggests that people value gains and losses differently. The value function is concave for gains and convex for losses, indicating that the pain of a loss is felt more intensely than the pleasure of a gain of the same size. This concept is known as loss aversion. Reference points. People evaluate potential outcomes relative to a reference point, often their current wealth or status. This reference point can shift based on recent gains or losses, which affects decision-making. Probability weighting. People tend to overestimate the likelihood of extreme, but improbable events, and underestimate the likelihood of moderate, probable events. This can lead to irrational investment behavior, such as overvaluing stocks with slim chances of big payoffs. Framing effects. The way choices are presented, framed, significantly impacts decisions. For instance, presenting an investment as having a 90% chance of success versus a 10% chance of failure can lead to different reactions, even though the probabilities are identical. In financial markets, prospect theory helps explain why investors might hold on to losing investments too long to avoid realizing a loss, sell winning investments too quickly to lock in gains, and make irrational decisions under risk. It provides insights into market anomalies and investor behavior that traditional financial theories, like the efficient markets hypothesis, can't fully explain.